Hello my fellow freedom builders and welcome back to the channel. Yesterday we had a video about Tesla since they are coming up with earnings here Wednesday, and today it is Netflix. Also remember, as I mentioned in the video yesterday, that these videos are recorded Sunday due to a bit of holiday in my schedule, so there might be a few changes in prices and stuff what you see on the screen, but overall this should be faring good. What we are looking at is Netflix. You know the company, the streaming service, and here Wednesday after the close of the market we can see that Netflix are having their earnings report coming out. And what they are forecasting, or the market is forecasting, is that it is going from just below $8 billion in revenue to around $8.3 billion. And the forecast for their earnings per share is a drop from 3.2 to 2.84. Now, we have seen already some S&P 500 companies that are beating the forecast, so that could be nice, of course. But this is the forecast, and if they're doing better than the forecast, it might send the price up, even though the actual earnings per share is lower than last time. But that is how it works in the market. Now, what I'm going to do in this video is I'm going to look at short, mid, and long term. And first of all, when we look at the Netflix here in my stock scanner, we can see that on the shorter term, it actually has a PEG ratio of only 1.4. That means that when you're looking at the PE ratio, the price earning, and divided by expected growth, you are getting a PEG ratio. That tells us if we are paying too much for future growth on the shorter term, and if this number is below 2, I normally say that it is fairly good. So just looking at this, it looks good. We can also see that the stock score is 87, the momentum is 95, quality is 95, but value is a bit low. We'll have a look at that on the longer term analysis in a second. We can see that the return on capital and equity are fairly good, and the operating margins are also decent. When we're looking at the earnings per share, they had a negative here in 22, but that is expected to grow quite good. And we can also see that the PE ratio should be going up and the PEG ratio should be dropping even further. So that is quite good. We can also see that the free cash flow is turning positive, and that is definitely something I like to see when I invest in a stock. All right, so looking at the short term, the TPI chart, we can see that Netflix is in a long-term green uptrend. We can also see that it is in a downtrend on the TPI weekly and on a downtrend on the daily here. Now, as we can see, the uptrend is fairly good, and just looking here in a chart, we can see that if we draw a regression channel, let me just catch this. It's just a regression line with plus and minus 2 standard deviations. We can see that it is in the upper half of the regression channel. I actually do like it to get a bit down here, but we'll also wait for these indicators to turn light red, meaning that they are in an oversold accumulation phase. So right now, I would actually not take a swing trade in Netflix. Of course, I wouldn't take it anyway because there are earnings just coming up here, and I don't take my swing trades just into earnings. But I won't say that I couldn't take it at some point. If it drops a bit below here, we come to past earnings, and we see some sort of consolidation down here, and then turning upwards. Then I actually think Netflix could be, on a shorter term, an okay swing trade, maybe getting the price down here on a weekly chart just below the midline, the regression line in a regression channel. Then it could be okay. However, I wouldn't take it now. Comparing to the Tesla yesterday, I actually like the Tesla swing trading setup a little better, even though I wouldn't take that either, just up in earnings. So that is the TPI chart. That is a short term. Then if we are zooming out, looking over a couple of years, if we're looking at the value chart, you might recognize this by now. We can see that for now we have the price here, and if the stock can keep its average price earning over the last 10 years and the estimates are coming through, then it all looks very fantastic that the stock could go from what, 442-ish here and then to above 2000. However, that is not how reality goes, because the reason why the average PE is so high is that if we're looking in the PE row here, we can see that there is a 200, a 407, a 290, 153, and that was in some years where it really went fast for Netflix here. However, when we're looking at the PE numbers, the later years here, it has dropped to 30, 40, expected here in 23 and expected 30 in 24. But let's zoom a bit in here. We have the 5 years. If we can have an average of 70 in price earning, well, it still looks like a decent investment that could double over a year. But let's zoom a bit more in. We have the 57 here. The stock could still go up around 800, but it actually only starts to get realistic when we get down here. If the stock can keep the estimates, if that can come true, and it can keep, if the investors are willing to pay around 40, 42 in price earning, then it could still be a decent investment from the 442 and up to around 600. That is something like 40% in a couple of years, and that would be okay. However, we can't see that right now, or the estimates are that the price earning will more likely be around 30. That is what it was in 22. Might be going a bit up here and then going down again. So if we are looking at the 30 range here, then we can see that the price here is actually above where the price in theory would be in a couple of years. So if the investors are only willing to pay around 30, then it's actually not a good price right now. And if we're seeing a bit of a nervous market, you could say Netflix was helped a lot by the entire Corona situation. People were sitting at home, they were streaming, everything was online. But right now, the world has opened again. There are a ton of competitors rushing into the market. And you could say, are investors really willing to pay more than 30 in price earning for something like Netflix? I can doubt that a bit. And if that is true, just in theory, and if the estimates are on the level where they expect it to be, then it's actually not a fantastic deal right now. That was over the next couple of years. Now, if you remember from the Tesla video yesterday, we also looked into Guru Focus. They have this discount cash flow visualizer here. And in that, and this is also a purely theoretical calculation and model. So that could be a million different things going in positive or negative directions here. So I'm not saying that this is the actual development. However, what this says is basically that if you want a 10% yield on your money, meaning that if you invested $100,000 into Netflix, it should produce $10,000 per year in profit that you could get either as a dividend payout or as an extra value into the company that could be invested and so on. So what you want here is 10% per year. We could manipulate that and say, no, I only want 8%, or actually I don't care, I want 5% per year, because what I want is some other growth stuff that could take place in Netflix. So if, for instance, that you wanted only 5% per year, and you were saying that it could grow its earnings per share by 10% per year the next 10 years, then a fair price of Netflix right now would only be 261 compared to the 441 it is right now. Now, normally, when to compare apples to apples here, let's just take a 10% yield here, or discount rate here, per year on the stock. That would give it a fair value right now at $162 compared to $441, meaning that you're getting a negative margin of safety of minus 172%. If you would say, well, I think they can grow with more than 10% per year. I'm not sure they can, but let's just say they can. Out here, we can see the earnings per share without NRI. We can see over the last 10 years, they have actually grown by 67% per year. However, that is of course both Corona time and it is the upcoming of the entire streaming industry and so on. Over the last 5 years it is down to 53%, also including Corona, and over the last year it is actually minus 15%. So 10% might be a bit more reasonable. We can see the numbers here are a bit closer to 10%, but let's say they could grow by 15% per year. Then a fair value would be 227. Still, the stock right now is at 441. So how much should it actually grow? We get a number up here saying around 25. So let's bump it up to 25. And we can see at 25, a fair value of the stock paying for it right now would actually be around 450, which is fairly close to where we are now. It's not giving us much margin of safety. To get that, let's say we want a 20% margin of safety, Netflix should grow by 28% in earnings per share every single year the next 10 years, and I doubt that that is possible. So that is completely up to you to estimate. Maybe you say to yourself, I think Netflix will win the streaming war. They will beat Disney Plus and HBO and what they call all of them. And they will definitely dominate the entire industry. So 28%, that is definitely right. If you think so, well, then a fair value to pay right now would be 550. So if you could get it at 442 here, that would be a complete bargain. I would say personally that I think the 10% per year is a bit more reasonable, which means that I would not, from a fundamental perspective, buy this. There could be all sorts of technical perspectives and say we are in a trend, all the big ones are going to buy this, and there are a lot of trend following strategies that could argue you should buy now, but that would be a stop loss and you would be stopped out if the trend breaks. This is from a fundamental perspective. Is Netflix good value over the next 10 years? And I think, in my personal optics and point of view, it would be a resounding no. Netflix is not a good value over the next 10 years. It is doubtful that it is a good value over the next couple of years. And looking at the TPI, there might be a setup for some shorter term swing trade here, but Netflix is actually not a stock that I would personally go into. But as always, this comes down to your own risk profile, risk management, your own strategies, the holding period you're planning to have in a stock and so on. Just remember that when you enter a stock, you need a plan on when to get out. I often get the question when a stock has dropped 50 or 80%, do you think it's the right time to go out now? And I cannot answer that because I don't know where the stock will go. No one knows where the stock will go. However, people asking me that, the stock had dropped 80%, is this the time to go out? That tells me they didn't have a plan. When I buy a stock, I always know what the criteria is for me to exit the stock. And I keep to that plan very, very strictly. So you should as well. Don't listen to me. This is just inspiration and some educational stuff. Use your own plan. Use your own strategy. I hope this made sense to you. I will get back to you shortly with new videos. Until then, take care of yourself and your money out there. Bye for now.